The stock market right now is doing what it usually does. It's going to be volatile. And for those who can't handle the volatility or don't have the ability to think forward, 10, 20 years, the stock market may not be a right place for them.
Here at Liberty and Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Jerry Robinson from followthemoney.com. Thank you so much, Jerry, for joining us today.
It's a pleasure, Elijah. I always enjoy it.
Definitely. Now, I wanted to get your update on, we've seen really since the beginning of the year a sell-off in the markets. Your take on the stock market currently?
Well, it all depends on what your time frame is. From a longer term view, we've actually moved into an area where there's a lot of opportunity, I think, for those with a 20-year time horizon, or even maybe a 10-year time horizon. But for those who are living in the moment and for those who can't think beyond the current moment, this is a dangerous time. And I would say that I've seen a lot of reactions, unfortunately, to this whole outcome. A lot of this was kind of obvious. It was pretty clear that it was going to happen. The interest rates were near zero, and the stock market was screaming higher in 2021. And it eventually peaked. Growth stocks peaked in February of 2021, and tech stocks in particular. November was the final peak for other assets, and then you can even think about gold and silver. They peaked back in July and August of last year as well. So we saw a lot of peaks. We knew that the Federal Reserve was going to have to do something, and we began telling our members, look, there's ways to make money, on the downside. And we were prepared for that. We saw that coming. Now we've really had that incredible sell-off. The S&P 500 at one point, I think, was down maybe 13, 14, 15% from its previous all-time high. I think it's trading at about 7% below that now. It's rebounded some. It all really depends. As I open this answer, it really all depends on your view. The stock market right now is doing what it usually does. It's going to be volatile. And for those who can't handle the volatility or don't have the ability to think forward, 10, 20 years, the stock market may not be a right place for them. I keep a small amount of money in the stock market for the long term. And I also like to speculate in stocks, cryptocurrencies, commodities and things like that. But no, I think that those who have a long, and I know some people may not like this answer. I know that some people just don't like the stock market. And I would say for those people, just don't be in the stock market. Nobody's put a gun to your head and said you have to buy stocks. No one has to be in the stock market. If you're going to be in the stock market, be wise. Don't sell when the stocks go down and buy when they're peaking, and then sell when they're bottoming and buy when they're peaking and sell when they're bottoming. This is a neurotic kind of way to handle stocks. So many people shouldn't even be in the stock market because they don't know what they're doing. If you're going to be in the stock market, you want to look for high quality assets that will outlast the United States government. The government's bankrupt. Apple's not. The United States government is bankrupt. Google is not. There's a lot of companies that are going to outlast the United States. Chevron is not bankrupt. In fact, so there's lots of companies that you can invest in, and you can say these companies are very likely going to outlast the United States government. And what I mean by that is their solvency. But if you don't want that, if you don't want to have any of those kinds of assets, that actually are solvent in the midst of insolvency, that have brand power and pricing power where they can handle inflation, they can raise prices, they have global audiences. Some people don't want to have any of that, and they shouldn't if they don't. I like the old Charlie Munger quote. Charlie Munger's one of the richest investors of all time. And he says that if you cannot handle a 50% decline in the stock market or in your stocks that you've invested in, then you deserve the meager returns that you'll receive. And I think a lot of people receive meager returns in the stock market because they don't know what they're doing. But people who buy right and sit tight and have patience in high quality companies, not everything, not junk stocks, not penny stocks, not meme stocks, real meaningful companies with real meaningful products, with real brand power, with real pricing power that will outlast the United States government. That's where I put a small portion of my own money, and where we teach our students that, hey, if you want to have exposure to the stock market, that's kind of a smart way. I think a lot of people view investing perhaps as all or nothing. So they say, well, I have to put all my money in the stock market, so therefore it's a bad idea. No, nobody said you had to do that. Nobody said you had to put all your money into the stock market. Nobody said that's the wise thing to do. The wise thing to do is to have a little bit of stocks, to have a little bit of real estate, to have a little bit of crypto, to have a little bit of this, a little bit of that, because you don't know what's going to happen. You just don't know. None of us know. And so I know there's a lot of experts who claim to know what's going to happen, but you and I have been around long enough in this scene to know that nobody knows.
I think that's so key. And even though the general stock market may be overvalued, there are some still key stocks, as you're mentioning, that still have value. And for the long term, people could still be investing in.
Well, again, there are a lot of overpriced. I want to just step in here and say, look, my favorite asset class is not the stock market. So I own stocks, and we're talking about stocks, but it's not my favorite asset class. And it's certainly not where I put the majority of my investments. But if you're looking at stocks, and if you're looking for high quality companies, and you're saying, I don't want to not have stocks for the next 30 years because I know that they have beat inflation consistently for the last several decades, especially high quality companies, then you're looking for companies that have pricing power. You're looking for companies that can raise prices and consumers pay it because their products are that important. You're looking for companies that are not strictly dependent upon a U.S. A domestic audience or consumer base, but a global consumer base. You would be looking for companies that are not woefully mired in debt, and you'd be looking for companies that have a proven solid management strategy that execute well and that are shareholder friendly. So if you had put money into stocks, let's say that you had bought Apple or Google or Microsoft back in 2009. Today, your $10,000 into those stocks would be, close to $100,000 or $150,000. Well, that's pretty good inflation protection. Now, many people hate those stocks. They despise those kinds of companies. They hate them. Well, that doesn't really matter. It doesn't matter what you think about the companies. It doesn't matter what your feelings are. We're talking about investments and protecting from inflation. So I would say that these are the kinds of companies, and not the ones I specifically mentioned. I mean, there's all kinds of companies that have pricing power. There's all kinds of companies that have really dominated their niche. And I would say that, I certainly don't want to give out stock names to people over the video because that's not how it works. You've got to really do your own due diligence. But if you drill down deep and you have a set of criteria, you'll find that there's good opportunities if you have a 10 to 20 year time horizon. If you have a 6-day time horizon and you want to know what's going to go up, well, that's going to be tough. But if you have a 6-year or 16-year or 20-year time horizon, well, you can focus on a high quality and again, not with 100% of your dollars. It's absolutely important, Elijah, that people understand that when you invest, you are not putting all of your money into one thing. So If someone says the stock market is just a bad place to be, well, that's fine for them. They don't need to be there. It's not bad for everybody, but it's bad for some.
No, we recently saw the Fed rate hike, and you have mentioned on some of your videos recently that conventional wisdom out there says if interest rates rise, that should be bad for stocks. But actually, we sometimes see the opposite. Can you expand on this?
Yeah, there's if you look at the data now, of course, unfortunately, in this world that we are in, there's so many loud voices and social media and in the corporate media, where you have all of these people, kind of pulling their hair out, and we kind of live in a kind of an outrage media cycle where everything has to be apocalyptic. And if it's not apocalyptic, then it's not really worth hearing about. And so when it comes to the Fed funds rate moving up, I mean, this just catered well to the idea of apocalypse. Like, this is going to be the apocalypse. This is going to be the moment when the Fed raises rates from 0% to 2%, then the whole economy crashes. Well, that's just not borne out in history. That's not typically what happens. But you still have people who don't know history who are out there promoting that theory so as to create an apocalyptic headline so as to get people to listen to them, because it's difficult to get people to listen to you in this loud world. So you've got to be more apocalyptic every single time. But in reality, if we're focused up on reality and just not, trying to, get clicks, then what we find is that the data doesn't bear that out. When you look at there's been 13 rate hike campaigns by the Federal Reserve since 1954. Using some Bloomberg data, you can go back and see that in 11 of those 13 rate hike campaigns by the Fed that was initiated by the Fed, the S&P 500 actually rose 14%, excluding dividends, during 11 of those 13 rate hike campaigns. From the beginning of the rate hikes to the end of the rate hikes, you got a nice 14% average return on the S&P 500. Now, that's not the apocalypse. Now, I said there were 11 out of 13. This is where it is a little bit concerning because on the other two rate hike campaigns that didn't work out so well for the stock market, they were mainly in the times of the 70s, which were the stagflation time, where you have rising inflation and slowing economic growth. Bad recipe. That's hard for the stock market to overcome. That's what appears to be what we're in now. So we may expect more muted gains from this rate hike campaign that we have now. But that's the data. The data shows that. Now, that doesn't mean that it has to be that way going forward, but that's just what the data show. And I think that's helpful for those who like to look at the data and say, how has history played out before, when they're trying to make their decisions about what's going forward. The way we look at it is that the interest rates now have, of course, nowhere to go but up. We've seen a bond bloodbath too, Elijah. I mean, just outrageous. This year's drawdown in government and corporate bonds has occurred at the fastest rate on record. Even 2008, the economic crisis that we had, you didn't see bonds enter this kind of swift sell-off this quickly. So it's been a very tough environment, and a lot of assets have been very volatile in this current environment. But we think over time that the Fed funds rate will rise, and then guess what happens? It goes back down again. And then guess what they do? They raise it again. And then what do? They lower the rates back down to zero. And then they decide that they have to raise them again. And then they lower them again. So basically, we're in a cycle. They all can't be the apocalypse. Maybe one of them will be. But this up and down of the interest rate is the most common thing that we have seen in the stock market or in the U.S. economy for the last many, many years. This is how the Fed works. So we have to get accustomed to the way that the Fed works, as opposed to fearing the way that the Fed works. The Fed is going to do what it's going to do. We can't stop it. We just got to get used to the waves that it creates. And there's lots of opportunity.
There's lots of opportunity. And I think one of the main, I guess you could say, factors out there right now is inflation, and it seems like this 0.25% rate hike isn't going to impact that too much. So where do you see inflation going in the near future, and how can investors hedge against that and invest accordingly?
Yeah. Yeah, inflation is pretty stout, and the official numbers that we have, Elijah, are woefully underreported. I mean, the current rate around 8% or so, talking about a 40-year high. I mean, those are the official fudged, CPI numbers from the Feds or from the Treasury and the United States government. So these numbers are not accurate, and I think everybody knows that. So we're dealing with very high inflation. So you can deal with this. I think the most appropriate way, of course, we talked about some ways in our last interview. We talked about 4 ways to deal with inflation. So we kind of addressed that on the last interview. But I would say that one of the very best things that people can do is, and I know I sound like a broken record here, but it is to be diversified, right? To be nimble. To not be all in on one thing. We have seen lots of people over the years, blow up their accounts before coming to follow the money because they were trying to go all in on one thing. And I think here's what I'm really trying to say. I think the current media fear around the current economy right now, I think the fear that's been generated is causing people to make very bad decisions with their money. Very bad decisions. We've been talking about this a lot on our coaching calls here at Follow the Money with our members and students about how a lot of times, you can get motivated to go do something wild with your money because of some report or something that is going to happen, but it doesn't happen. And therefore you've kind of made this move with your money. And then suddenly, oh goodness, I'm now sitting on a loss. I think it's important for people just to, again, diversify and simplify it. It shouldn't be terribly complicated. It should be fairly straightforward that we keep our money diversified, have some gold and silver, right? But you don't have to buy gold and silver miners. You don't have to. Now you might want to. You may say, that's exactly what I specialize in. Good for you. But you don't have to run out and buy gold and silver miners, especially if you have no clue what you're doing, right? You don't have to go out and run out and buy. You don't have to listen to everybody's recommendations and go buy all of those things. What you want to do is you want to do research and say, okay, what does well in times of inflation? And what does well in times of inflation historically is gold, precious metals, agriculture, commodities, and energy. Those are our PACE strategy. Also, real estate does well. And ironically, stocks do well. High quality stocks do well. So if you're avoiding all of those areas, then you're definitely not going to be able to keep up with inflation. But those are areas that you can be invested in and preserve your purchasing power and then some.
No, we have seen a significant move in energy and oil, and everyone is definitely experiencing that at the pump. Your take on what we've just seen, and are you still bullish on oil and energy?
Yeah, energy has been a wild ride. So some of you may remember when oil went down below zero back in 2020. It was a wild moment where the price went negative on a barrel of oil. You would actually get paid to take a barrel of oil at that point. We issued an alert to our members at that time on oil ETFs and did a long call option on those ETFs over it was like a 2-year option. And of course, oil went from negative prices all the way up to where it is now, for the last 2 years. It was an incredible potential rally for those who were paying attention to the oil markets. When things get that out of shape or that out of a range of the historical range, you've got to pay attention. I think where oil is now, nobody's guess as to where it's going to be tomorrow, but I do know that based upon the IEA reports and some of the energy reports that I've read from the Department of Energy, there's the expectation that we're going to have more oil than we need. There's going to be a surplus towards the end of the year, probably the last half of the year. Energy producers are pumping feverishly, trying to take advantage of high prices. And the cure for high prices is high prices. So this is why you also see movement into solar energy stocks, renewable energy stocks right now, which have been beaten down. But because energy prices have gotten so high, gas prices have gotten so high, renewable energy sources are becoming even more attractive, than they were even before because of high crude oil prices and natural gas prices. So I don't know where oil is going to be tomorrow, but I do suspect that we're going to have more supply than we need probably by the end of the year based upon the forecasts that I've seen. But also, I suspect that one of the biggest winners out of this whole crude oil spike is going to be renewable energy, because people are tired of being held hostage to the oil producers like Saudi Arabia. Saudi Arabia says, hey, we'll cut, or we'll add some more oil, President Biden, if you'll help us bomb more people in Yemen, if you'll help arm us so we can keep bombing people in Yemen and all these other places. That's not who we want to do business with. I'd rather have solar tiles on my roof and not have to worry about what Saudi Arabia wants me to, who they want me to kill or who they want me to fund killing. So I'd say renewable energy is a big winner out of this huge spike in crude oil. And I say by the end of the year, my guess, based upon the best forecasts that I've seen, is that we'll see some alleviation from these higher prices towards the end of the year. And in fact, if there's a peace deal that's brokered between Russia and Ukraine, which I don't see coming immediately, but if that does happen, then you could expect to see oil prices fall off a cliff quickly before they kind of rebound. So anyway, if you're long oil here, you've had a really nice ride. And I would say at this point, the risks, are probably higher than they have been before about a potential sell-off. So if you've enjoyed the ride in energy, you've had a great ride. There's still plenty of upside, in my opinion, longer term, because energy prices have been suppressed to some extent. But I would still use extreme caution here, considering the incredible rally we've had.
Now, what about precious metals? We have seen an incredible rally in those as well. Maybe not as dramatic as oil, but we did see gold touching an all-time high a few weeks ago. Now they're cooling off a bit, but do you see greater upside potential in the short term for precious metals, or maybe a further pullback coming?
Yeah. So let's talk about them individually. So gold, we're looking at about a roughly 2050 resistance level on gold. We're long gold. Gold has been one of our favorite assets for a long time. Physical gold, physical bars, physical bullion, not collector's coins, not, and to an extent, gold mining stocks only if you know what you're doing. Again, if you don't know what you're doing, it's better. I would say it's better just to have physical bullion and not try to worry about all the speculation unless you know what you're doing. But physical gold is a great idea, I think, for someone's portfolio. It's an anchor in my portfolio. And then also silver. When you look at silver, our range, technically speaking, is somewhere between 2150 on the low side to 2850 on the high side. Now, we've been gyrating between that since last August when we hit that kind of upper peak. Same thing on gold. So right now, we're just kind of gyrating in this consolidation zone. I like the fact that we've consolidated this long. That's usually an indication that when you do get the breakout above the higher channel, that you actually get a big run. So I really do think that gold and silver and platinum to that level, to that extent as well, are very well poised to have a nice run beyond their resistance levels, beyond the 2050 cap that we have on gold right now, beyond the 2850 cap that we seem to have right now on silver, that resistance area. I do think that once we get past those areas, that yes, we will have a large rally. But until those resistance areas are taken out, it's just great accumulation time.
You mentioned how this is great accumulation time. And I guess that's the way I see it is we believe we know what is coming ahead, which is a greater rally. And right now it's just metals are in sale, it seems like.
Yeah, I think so. I think I'm also glad that metals didn't have this crypto-like rally early and then just failed and then had all this overhead resistance over it, which would have been pretty tough to break through. So gold and silver haven't gone wild. I mean, they really haven't, like oil has or like crypto. It's not been. So in other words, what I mean is that somebody would say, well, that's a negative thing. Well, I think it's actually kind of a good thing because again, when those breakouts do happen, the longer that you have that consolidation before the breakout, the more meaningful and powerful the breakout is. So yeah, I am bullish on gold and silver. Own them both. Own physical silver, physical gold, keep them in your possession is my philosophy. We see good things ahead for those, but also stating that if we don't see those good things, it's okay because we have other assets. So we're not all in. Our financial plan is not gold must go up or my financial plan is destroyed. We are going to benefit if gold goes up, and we're going to benefit if gold doesn't go up, because you want to create an investment portfolio that weathers any storm.
All right. Well, Jerry, we really appreciate your time today. We have an affiliate link our viewers can go to. It is followthemoney.com, and all you have to do is put in the promo code LIBERTY. So very easy to remember there. But did you want to share with us a little bit about the program you have over at followthemoney.com?
Sure, absolutely. And your members or your listeners can join, as you mentioned, with that Liberty coupon code, followthemoney.com. Just go to followthemoney.com and click on the plans and pricing. You can see our silver, gold, and platinum memberships, kind of appropriately titled. But each of these areas, if you're looking to learn how to trade, you might have heard me talk about gold and silver miners here on this interview. If you don't know what you're doing there and you want to learn how all that works, that's what we do. We help you learn how trading and investing work. I've been investing and trading for 25 plus years. Hard to believe. I've been training people, around the world on the topic for the last 10 to 12 years. So that's what we do. We really want to help you achieve financial liberty, but that's not going to come through some silver bullet. You're not just going to be able just to buy something and then your whole financial plan is solved. That's not how it works. You've got to have a holistic plan. You've got to bring it together. And if you want to learn how to invest, trade, buy gold mining stocks, buy high quality stocks. If you want to learn how to trade cryptos, or you want to trade ETFs or invest, create an investment portfolio, all of that we do here. As you well know, Elijah, you've seen what we do here. You know that we're providing ongoing education, and we also do a weekly group coaching call during market hours. So people can tune into that. That's one of our most popular things that we do every Tuesday morning live. So you can dial in, ask questions, find out what's going on in the market. And it's a great time. So I'd love to have your listeners come and check us out. And at the very least, come and check out our free podcast and our free YouTube channel and all the stuff that we do on our website, followthemoney.com. But it's been great. Don't forget, if you're listening and you do want to check out one of our memberships, we have a free 30-day money-back guarantee, no risk to you. And if you want to use the Liberty Finance and Liberty, or Liberty and Finance coupon code, it's Liberty. Be sure to type that in at the checkout so that Liberty and Finance will receive some monetary support for their good work as well.
Definitely. Well, Jerry, really appreciate your time today. Again, the website is followthemoney.com. Promo code is Liberty. Thank you so much, and God bless.
God bless you, my friend.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, The price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.